like in India, where they, every quarter we come up with a repo rate, either it's reduced, increased, or remains unchanged. In the same manner, the US Federal Bank also comes up with the Federal Reserve rates. So we'll see today, since recently it has come up with a reserve rate, we will see what has it done. At the same time, we'll see what will it lead to specifically in case of India, what impact it will have, and if there are any negative impacts, how can we address that. So let's get started with it. So why this particular thing in news is because recently US Federal Reserve, they have maintained the interest rates in the target range between 5.25 to 5.5%. They have maintained this. Okay, they have neither reduced, increased, they have maintained this particular range, right? And they indicated that borrowing costs are likely to stay higher. Borrowing cost of the money is likely to stay higher. People are expecting it to come down, but it has indicated that going forward it is likely to stay higher instead of coming down. Okay. If you look at the annual inflation rate in the US, it is actually low. The Western world generally is having a very low inflation rate. So presently it is at 3.5%, UK 3.2 and 2.4 in Eurozone. So you can see the West world has lower inflation rates. So at lower inflation rates, as compared to specifically India or the South Asian economies, the South Asian economies are having a higher inflation rate, and also the growth rate of South Asian economies are also higher. Now there was a question in UPSC in a few years back, I don't remember the exact year, but the question was economic growth is usually accompanied by, and the options were A, disinflation, B, inflation, C, skewflation, D, deflation. And the correct answer to this, guys, is inflation. And economic growth is usually accompanied by inflation, and hence you can see the correlation. South Asian economies having higher inflation and also having higher growth rate. The Western economies having lower inflation and also lower growth rate. Okay. Anyways, so presently it has maintained in the range of 5.25 to 5.5 and says that in the coming future, in the recent coming future, it can be higher. Now, what are the reasons for US federal decision? Inflationary pressure. Why has it not lowered the rate? Because of inflationary pressure. Why? Because in the Western world, as I said, the inflation rates are quite low, but even then USA is higher. USA is still higher than European Union, Eurozone, which is way less, and also higher than UK. Right, so it is almost 40% higher. Inflation in US is 40% higher than in UK. Here it's just 2.4%, it is 3.5%. So that itself in the Western world is considered to be slightly higher, as a result of which it could not lower the interest rate. Okay, US inflation rate peaked in 2021 and 22 at 7 and 6.5%. Now these are generally the usual. It is the peak for USA. In South Asian economies, these will be the usual, rather a lower inflation rate, right? So it peaked and then it had declined by the end of 2023, but still remains at this. Why we are saying still 3.5% is high? Because their target is 2%. Their target is 2%. That is the logic. In India we have inflation targeting. We target inflation at 4 plus minus 2%, which gives us a range of 2 to 6%. In USA, they are targeting this number of 2%. This is significantly above the US Fed's target of 2%. Now, since it's above the target, that is why you cannot lower the interest rate, because it will further lead to inflation. Now, another reason is the wait and see approach. Generally what happens when you don't understand what to do? You keep it the same and see what happens. Let's get ourselves some more time to see where the economy is going, or some more time after another quarter to see where it is going and have more data, and then decide should we reduce or not. So sort of a wait and see approach, or the waiting game is there. Right. Now, the question is, why do central banks resort to a rate hike? Why do they resort to a rate hike? We are talking about. When we understand why they resort to a rate hike, we will also understand why they may reduce it. So, when there is inflation, when inflation is high in the market, that means what? More money chasing less goods. Now when more money chasing less goods and you want to control, remember our RBI also has 4 plus minus 2% of the targeting. So if inflation is going higher beyond that, we need to control it, bring it down. So inflation higher means more money chasing less goods. So what do we have to do? Either you increase the production. Now production increment will take time, because then industries need to expand, new players come into the industry and open the businesses, or you can import also, but import is not a very long-term thing. It's a short-term thing on an emergency basis is fine, but ultimately you have to increase the production, which will take time. So there is another way. What is the other way? Either here you can make more goods, or here you can make the money less money in the market, or you can do both, right? So how do you make money less in the market? By increasing the interest rate, by increasing the repo rate. In India it is the repo rate. What is the repo rate? It is the rate at which the central bank, that is in India the Reserve Bank of India, gives money to the scheduled commercial banks, which then in turn loan to the people, to us. So if this repo rate itself is high, so the money that the bank will get will be at a higher interest rate. Hence the loans that it gives us will be at a higher interest rate. When the RBI is charging high interest rate to give money to the banks would want lesser money from the RBI. So when lesser money banks want from the RBI, they will have lesser money to give. At the same time, the loan interest rate is high, so less number of people would want the loans. So again, further lesser amount of money people are having in the form of loans, and hence less money in the market. Less money in the market means you have tried, or you have done something or the other to bring the inflation down. So that is why rate hikes are there. Now the opposite will be reduction in rates. When you reduce the rate, banks will want more money. Banks will want more money because repo rate is reduced, and they will be able to give more money to us as loans, and the loan interest rates would also be lesser. So we will be wanting more and more loans. Hence then money supply in the market will increase, and then it can lead to increase in inflation if the inflation was going too much down. Okay, so that's the logic of increasing or decreasing the rates. Now how does federal rates impact Indian economy? Capital outflow. Simply because when the federal rates are increased, like in India, when the repo rates are increased, the rates of everything increases. The rates of loan increases, the rates of fixed deposit also increases. That means now if you put your money in fixed deposit, you will be earning more interest rate on that. So now if the federal bank increases the rate, if you invest your money in US, you will be earning more interest on the fixed deposit or other instruments. So the capital will outflow and would want to fly away from India to USA. Clear? So that is one thing that can happen. Then further inflation can happen. When money is flying to USA, in India the dollars are less, abroad the dollars are more, and everyone now wants dollar to invest in USA. So dollar becomes a hot currency, everyone wants it anyhow, and now more people want it. So the value of dollar will increase. So the value of rupee will come down, right? Now changes in US Fed rates can have significant effects on capital outflows. Capital flows as in capital outflows, it will outflow. because value of dollar has gone up and value of rupee has gone down, exchange rate would be now further distanced. Earlier, let's say $1 was 75 rupees, now $1 would be 80 rupees. So making the dollar costlier, leading to inflation. Right? Further, of course, we saw this point, weaker rupee, the rupee would be weak. When rupee is weak, imports will be expensive. Earlier, let's take an extreme example. If $1 was 50 rupees and now $1 is 100 rupees. So if earlier you were importing something worth of $1, you had to pay just 50 rupees. Now if you are importing something worth of $1, you have to pay 100 rupees. So what has happened? Your imports have become expensive. But the positive side is that your exports are cheaper. So more countries will now want your exports. Why exports are cheaper? Now let's say a USA citizen in USA wanted to buy this pen, let's say was made out of 50 rupees. So if they want to buy one pen and earlier $1 was 50 rupees, this pen was made of 50 rupees. Now also, even if the exchange rate is different, the pen will be made still in 50 rupees because it's the exchange rate that has changed. Internally in Indian economy, the value of the rupee is the same. So earlier you were making this pen for 50 rupees and $1 was 50 rupees. So to get one pen, you have to give $1 away. Now also this pen is made of 50 rupees, but now $1 is equals to 100 rupees. Therefore, for 50 rupees, how many dollars you have to give? Just $0.5. So now one pen is going to cost you just $0.5. So it is cheaper, more people would want it, your exports become cheaper, right? So that's a positive. Stock market fluctuations, since people are taking their dollars out, investing elsewhere, the stock market would fluctuate. People who are investing in other companies in other country, right? So that fluctuation will also be there. How can India reduce the impact? How can we reduce the impact? By balancing the interest rates. If let's say Federal Bank has increased the interest rate by 50 basis points, that means by 0.5%, India can also sort of increase, let's say by 0.25 or 0.5 depending upon the numbers. So you can balance it like that. The other way is diversifying the reserves. This is also a very good way. Diversifying the reserve basket. If our reserve basket of foreign exchange currency has a lot of dollars, reduce the amount of dollar, have pounds, euros, yens or gold, so that slight change, increase, decrease, fluctuation in dollar does not have huge impact because your basket is diversified. So these are the things India can do in order to address any fluctuation in the US Federal Reserve Bank rates or in the value or what is happening with the dollars. To have lesser impact, we can diversify our reserve basket. So this is what a US federal rate can impact, how it can impact the Indian economy and what we can do to minimize its impact. Thank you.